Welcome back to QAV, Tony. Episode 811. It's one off 911, which is kind of what the market's been like. It's been a bit of a 911, the market in the last week, but recovered last day or two for some reason. I don't fully understand. Market's gone, it's all okay now. All that craziness. Sure, it's gone away. I know something about interest rate cuts in the US. No tariff relief, but anyway, how have you been? How's your week been, Tony?
Good. Yeah, really good. Yeah, and the market's up today, which is good. But who knows why? I've seen articles saying that
Yeah.
people are seeing value in the US stock market. Not so sure about that. And if they didn't like it last week because Trump was doing strange things, that's not going to stop.
It's all different.
I
It's
saw,
all better this week.
I saw a link last on the weekend saying that Trump declared himself the winner of his annual tournament at his golf club, which I thought was hilarious.
Of course he did.
Yeah.
Well, let's start off with the portfolio update because I did my newsletter this morning. Dummy portfolio was up 3% in the last week versus the benchmark, which was down 0.18%. We're still 12% per annum up for the financial year versus 5% for the benchmark. So vis-a-vis the benchmark, we're doing quite well this year so far. But it's particularly grown like in the last, with this recent downturn, I think I even said on the show last week, or maybe, no, it was on the US show that we did, that when downturns happen, we're not immune from them. But this latest downturn, we did drop a bit, but we've recovered far better for some reason. Might be some of the stocks that we've had that have had good weeks. I don't know.
Well,
The
yeah.
US portfolio also recovered this week. It's up 38% for the financial year versus, wait for it, the S&P 500 up 3.6%
USA,
for the financial
USA.
year. So
Slightly
we're
better than
doing
inflation.
10 we're doing 10 times better than the S&P 500 over there with no Mag 7 stocks,
Probably why.
obviously.
Yeah.
I did have to sell a stock this week and replaced it this morning. I did a new US buy list for those people that have been asking me to do a US buy list. There is one up on our website. Well, yesterday by the time you hear this, but on Tuesday our time. Weird little company I bought too, but I won't bore people with it. We'll save it for the next US show. Anyway, 10 times the S&P 500 this financial year. It's just bonkers. Absolutely bonkers.
Mm-hmm.
But there's been some winners and losers this week, which we can get into. What do you want to start off with, Tony, in your list of talking points?
Yeah, well, I think one of the winners/losers, probably more of a loser this week, has been Ramelius Resources. And I know that's also a question from one of our listeners, so I may as well cover it all off now. I'm scratching my head at this one. When I did my results roundup on Ramelius, I thought it was a good result. And I'll read from Stock Doctor's summary. Okay, so this is from the 5th of March. Stock Doctor said that they're initiating coverage of the gold producer Ramelius Resources as a star growth stock following analysis of its half-year result and operational risks. We did a pulled pork on Ramelius about 12 months ago, so people can go and listen to that. I was thinking about doing it again, but I'll cover off most of the recent issues today anyway. Their big operation is in WA. Mount Magnet and Edna May are two of their mines, among others. They've also been on the acquisition trail over the year, and Stock Doctor report that they bought Spectrum Metals and Apollo Consolidated in recent years. Their performance was good for the first half of 25, revenue surging 46%, driven by higher production and rising gold prices. Net profit after tax soared 313% to $170 million, reflecting a robust 61% cash operating margin. The company achieved an average gold sale price of $3,541 per ounce, that's Australian dollars, well above its all-in sustaining costs AISC of 1,699 AUD per ounce. Their return on invested capital was 44%. And Stock Doctor said, with solid free cash flow, a low hedge book, and a conservative balance sheet, Ramelius is well positioned to take advantage of the strong gold prices. It also holds a strategic investment in Spartan Resources, a growing gold explorer. So tick, 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 tick. The only question I had about the results was $16.99 for its costs, AISC costs, is getting up towards the high end of the range. But when the gold prices are we're just about double that, it's still a healthy margin. So roll forward a week, and Ramelius came out with its plan, or its long-term plan, for its flagship Mount Magnet mine. And Stock Doctor again put out an update because that Ramelius announcement was not good. Ramelius's latest plan for its flagship Mount Magnet mine was weaker than expected, with annual gold production now projected at 140,000 ounces, significantly lower than the previous estimates of 173 to 182,000 ounces. However, the mine's lifespan has been extended by 10 years to 2044. The company is investing heavily in expansion, with total capital costs nearly doubling to $823 million, well above market expectations. Also, a $95 million mill expansion will increase processing capacity, but long-term throughput is expected to decline due to harder ore. Maintaining full capacity would require further costly upgrades. To manage financial risk, Ramelius has put price protection measures in place, securing a hedge for 22,500 ounces of gold in 2027. This helps offset the impact of rising costs and lower early-stage production. We anticipate negative earnings revisions to flow through following this update and place the stock under review as we assess changes to its outlook. So that's a week after the results announcements come out. It's possible that they took the following week to finalise their numbers on their long-term plan for Mount Magnet. It's also possible they knew damn well what was going to happen and could have announced the Mount Magnet review at the same time as their annual results. But anyway, a week after Stock Doctor praised them and made them a star growth stock, they put them under review. The share price tanked. I think at the time of the announcement, it was around $2.70. It dropped back to around $2.20. And then yesterday we get the news that Ramelius has made an offer to acquire Spartan Resources, the company he owns 19% of now. So that summary is Ramelius Resources plans to acquire Spartan Resources in a $2.4 billion deal to create a larger, more attractive gold producer. Spartan shareholders will receive 0.25 cents in cash and 0.6957 Ramelius shares per Spartan share, valuing Spartan at $1.78 per share and 11% premium. The merger comes as gold prices hit record highs above 3,000 US per ounce. The combined company will be worth $4.2 billion, targeting 500,000 ounces of annual gold production by FY 2030. They go on to say Spartan's board supports the deal. Ramelius aims to boost Mount Magnet's output and margins by acquiring Spartan's high-grade Dalgaranga gold project, while also achieving cost savings by eliminating duplicate expenses. So in other words, the timeline is release good results, share price goes up. Release bad forecast for Mount Magnet mine production, share price goes down. Release plans to acquire Spartan Resources to replace Mount Magnet lost production. Share price has gone down 2 cents, probably because of the costs that Ramelius will incur in doing the acquisition. But all of those three things require a fair bit of planning, and they should have all been announced fairly close to each other, closer than within 2 weeks of each other.
So just looking at, I've got the chart open, it was actually at $2.80 on the 10th of March. It dropped down to $2.09 on the 12th of March. So that's a big drop. It's actually up to $2.20 today. So it's recovered a bit since then, but that was a massive drop.
Yeah, so this is either a lot of moving parts happening all at once, and the board couldn't get itself organised to do anything quicker than what it did. Or it's a breach of disclosure, continuous disclosure rules. And it'd be a hard one to prove, given that everything's happened within a couple of weeks. The board would say it needed the time to prepare to announce things properly. But it just seems ham-fisted at best and a problem with disclosure at worst. So I've been thinking, that I'm more inclined these days to say we can't rely on ASIC or the ASX to enforce continuous disclosures. So maybe we need to start red flagging these companies that aren't giving us good disclosure and just refuse to deal with them. And so it's a hard one. I mean, if only we had a regulator who could tell us whether this was a breach of continuous disclosure or not, it'd make it easier. But I mean, we saw results that are a surprise on the downside from Fortescue, from Bendigo Bank, from Ramelius's results were good, but then their plan for Mount Magnet was bad, and then they've patched that with the announcement of the acquisition of Spartan. So yeah, it's a hard one. I'm thinking about slapping a red flag on this company to improve its disclosure, until they improve their disclosure.
Well, a couple of things on that. Number one, I had a chat with Chairman Mab this week, and I know you have been chatting with him as well about this, Chairman of the Australian Shareholders Association for new listeners. He's coming on the show next week to talk about this. He's been doing his investigations as part of his role at the ASA. He's going to come in and share what they've discovered, what their conclusion is. Secondly, I want to just disclose that I own 2 parcels of RMS in my super fund and a couple in the light portfolios as well. One parcel in my super fund I bought back in March of 23. I've held it for 2 years. It's up 97%. But the second parcel I bought February 25 and it's down 12%. The light parcels are down 9% and 17% respectively. So in the third question, if you're talking about red flagging this, would that be a red flag don't buy it or a red flag sell it? What kind of
it's a good question,
red
isn't
flag?
it?
Are we talking a red flag? Do we have a double red flag status? Because sudden CEO or CFO resignation is a immediate sell.
Correct.
Red flag. A qualified audit is a don't buy red flag.
Mm-hmm.
If is qualified audit a sell red flag? I don't know if we've ever had that arise.
Yeah, we have. Yeah, it was a sell. I think Apollo Tourism and Leisure had a qualified audit when it was in one of our portfolios.
That was a long time ago.
Yeah.
As long-term listeners will know, my nemesis, Apollo Tourism. So yeah, what do you think about non-disclosure?
It's a good question, isn't it? It'd be a red flag don't buy for me, I think, rather than a sell, because the sentiment's still holding up. And look, I'm not even sure about red flagging Ramelius because, like I said, these things have happened sequentially, and the board could perhaps argue that, you can't just do everything at once. It would, there was a bit of planning and preparation required to get the information out there in detail.
The acquisition of Spartan I can buy, but, the performance of the Mount Magnet mine, surely they knew that when the results came out. They should have known that. That's part of preparing your results, right? If you're a mining company, is getting your mine managers to tell you what they think the outlook is for the next year, 2 years, 5 years, and that's the whole point of a report, is to report on how your business is going. Well, you can't put out a report and say, well, we couldn't report on how the business is going when we put out a report because we couldn't get our ducks lined up in time. Like, that's your job. You have one job.
Look,
on how your business is going.
I'm not going to disagree with you. I'm kind of reluctant to put a red flag on Ramelius. As you said, it's been on the buy list for a long time, on and off anyway. I've owned them in the past. I've been happy to own them in the past. They've done well for me in the past. The gold price is flying. I can't see much that's going to bring the gold price down given the vacillations that are going on in the US and and the heightened volatility in the stock market. So, yeah, I think you're right. I think it's not a red flag don't buy. But it's probably a red flag don't. It's not a red flag sell, but I think it's a red flag don't buy. Um,
Right. So
so,
are we going to add a column
is
to
that
the
an?
checklist now?
I don't know. I haven't really thought through this at all. I just got pretty upset with the announcement yesterday. It almost, to me, it smacked like they were patching up their mistakes from last week when they announced the Mount Magnet mine wasn't going to do as well as first thought, was going to cost more. So they've gone, what can we do about that? Oh, we own 19% of the next door mine. Let's launch a takeover to plug the gap.
So is
That's
a
what it smells
continuous
like.
disclosure is a continuous disclosure red flag different to a confession season failure flag, or are they the same flag
I don't know. Why don't we just
in
think
theory?
about it for another week or something? But they're all good
Well, I've got
questions.
a question later on about the last time you said you needed to think about it, which was, do we really need the original byline if we have the second byline? I think it was like 18 months ago, the last time you said, I just need to think about it a bit. So we'll get to that later on.
Oh, will we? Okay.
I'm not so sure about
I'll
this.
think
I need to
about it.
think about it a bit thing because they.
Well, you're asking good questions and I don't have an answer for them. So all I can do is think about it. All I've got in my notes is I'm thinking
Okay.
about putting a red flag out there for continuous disclosure. Um,
Yeah, I think it's like, I think we've been, we've seen a number, there's too many of these things
yeah.
recently. This is really a disturbing trend. In all of my years of investing experience, Tony, 5 of them, whatever it is, I'm shocked that there is gambling going on in this establishment. It just seems there's something in the water. There's
Yeah.
like some word has gone around. We don't need to do that anymore.
I think you're right. I think because in my 25 years plus of investing, I don't think I've ever heard of anyone pinged for breaching continuous disclosure. There's certainly been some class actions which have uncovered it, and that's the disgrace that goes on with our share market. It's a regulated market, but it takes class actions by lawyers to point out lack of continuous disclosure. Not that there's been a whole heap of those, but there's certainly been some, but not a lot. And I think you're right. Directors are just saying whether they're overworked, whether there's too much red tape, they're just going, continuous disclosure, forget about it. No one's ever been pinged, and they're not doing it.
Mm, mm, mm. Or they get a slap on the wrist or a tisk tisk and a finger
Yeah.
waved at them, and
And I'm also not sure that if we put a red flag on a company for a breach of continuous disclosure, that solves the problem, because they're the company that's probably learnt their lesson. And it's going to be somebody else who does it next time. So um, that's why I think I've got
how
to
have they
think
learnt their
further.
lesson?
Well, the share price has tanked after they surprised the market. I mean, that's one thing that will be ingrained in the memory of boards is, hey, CEO, last time you did this, share price dropped from $2.80 to $2.08. Don't do it again.
So, which makes me ask the question, why not disclose during confession season,
You
whatever it
should.
is? I mean, if you don't disclose because you're worried the share price is going to take a hit, then you finally come out with it and the share price takes a hit.
It's
It's
worse.
not like you're the government releasing bad economic figures at 5 o'clock on a Friday and you hope you're going to get through the weekend media cycle and everyone will have forgotten about it. You hope Donald Trump does something over the weekend to take everyone's mind off it by Monday. I mean, the if you're a decent sized company, analysts are going to see this, the market's going to react to it. You're not going to get away with it unless you're a very small company that doesn't have a lot of coverage. So I don't understand what the thinking or the incentive behind not disclosing would be. I can't make the algorithm work here.
Oh, I think it's at best some kind of bad gamesmanship. If we put out good results first, then we announce bad news, then we announce an acquisition to replace the bad news. Maybe they think they'll get away with it. Would be one
But that's
strategy
this
I can
particular
attribute to them.
instance. I'm
I don't
talking
know if
about,
that's the case in this case.
but I'm talking about all of the companies we
Yeah.
saw
Well, they're scared.
sort of just skip confession season.
They're scared. Either they think they're going to get away
Of
with it,
what?
or they're scared that when they do
How did?
announce the bad results, they're going to take a hit. But it's like Buffett says, all he wants from his managers are, if you have good news, write me a letter. If you have bad news, pick up the phone. You've got to get in front of bad news. Just get it out there, you know, confess, as Buffett does in his first line of every annual report. I stuffed up this year, and here's how. Just get it out there.
Yeah.
It's because
Yeah, you gotta
CEOs are
love that.
salespeople. They don't want to announce bad news.
But again, as you said, like it comes out eventually.
Yep.
The share price takes a hit. So
Yeah.
I just don't. I mean, like I don't know. I've never been a CEO of a publicly listed company, so I don't know what's involved. But it just seems like it's a no. There's no upside for
No.
them that I can see apart from kicking the can down the road by a couple of weeks or a couple of months.
Yeah. Yeah. Look, I think Ramelius kind of shot itself in the foot. No one was asking for a 10-year update on Mount Magnet mine expansion. It's a bit like you don't hold a royal commission until you know what the answer's going to be. It's like, um, why did they even announce a 10-year update to Mount Magnet if it was going to be bad news? Like, just don't finish the report, put it in the bottom drawer and bring it out when the news gets better, or when you've got an update that will be thought of kindlier by the market.
So now you're saying they shouldn't have disclosed that.
They had to once they knew. All right.
Yes.
But that's
Yeah,
what I
once
mean. This
they
is
knew.
almost idiotic. Like they spent all that time putting it together, which means they have to disclose it.
Yeah.
At some stage during the process,
Yeah.
someone would have said halfway through, check this spreadsheet. Not looking good, boss. And the boss should have gone,
Yeah.
yeah, go and do some more numbers. And I'll think about it.
Should have gone la la
I'll
la
think
la la
about
la
it.
la 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 la.
Let me
Yeah,
think
I'll
about that.
it. Yeah. Yeah. All right.
Hmm.
Moving right along. What else you got?
Okay. Well, I come across a story which, again, I'm thinking about, is amusing. I am musing about this, and this was in the Fin Review. It was titled "Small Caps Trampled in the Rush to ETFs," and it was an article which was slanted towards saying that there were a lot of companies outside the ASX 300 which were being starved of capital. So there's a whole background part to the article which talks about how companies in Australia tend to list earlier than companies overseas because there's not as much depth of private equity funding in the early stages in Australia. And so they list, listing's expensive and it comes with all the red tape of listing. Traditionally, that has been the road to raising money as they need it to grow. But now that's not happening as much or as well because, and I'll quote from the article, where are we now? Oh, look, back in 2022 or 2023, the government mandated, let me just try and find it. Here we are. Big Super started to put small and micro caps stocks in the dumpster in 2022 when the federal government's Your Future, Your Super legislation made the S&P ASX 300 the benchmark for MySuper's Australian equity market returns. The government was warned at the time that the MySuper benchmarks could encourage short-term decision-making, discourage investments that were not well represented by the benchmarks, and reduce choice diversification, active management, and innovation. That's precisely what has happened. Big Super embraced index hugging to avoid being pinged by the regulator for poor performance of their MySuper products. This profound structural change contributed to the closure of many small and micro cap funds, as well as the exit from the industry of half a dozen small cap fundies. So, in other words, MySuper is the way the government benchmarks superannuation results. They were told to benchmark to the ASX 300, and as we know, fund managers tend to find it hard to beat the index, and so they tend to cling to the index and only make some slight movements away from it, so that if they get it wrong, they fall a little bit behind, and if they get it right, they fall a little bit above, and they can boast about their outperformance. What it has meant, though, is that a lot of passive money has gone into the ASX 300 in the last 3 years that wasn't there before. And that's what's got me thinking, rather than, yes, I understand that the small caps are being starved of capital raisings because super funds are being forced to to not invest in that area. But it also means that there's less passive funds going into that area, which might give us an advantage. And one of the things I was thinking about was that, when we see Commonwealth Bank trading as the richest bank in the world, largely on the back of index fund money going into the ASX 300 or even higher up the flagpole, I'm wondering whether we shouldn't be focusing on outside of the ASX 300. And it's certainly been, because I'm now having to buy large caps, I think I'm not getting the performance that dummy portfolio is since 2022. I think you've said something similar about your self-managed super fund or your super fund having to invest in ASX 300 stocks. And I'm wondering if that's the reason that they're being hammered by passive investing, which is forcing up the valuations on those stocks. And that I've always liked to invest where fund managers are looking, and I'm wondering whether that means we focus on the smaller caps now. There's 1,700 of them. The cutoff seems to be around $8 billion market cap, so we've still got plenty of space to operate in. Yeah, look, I think more thought required. I had a look at Wilson Asset Management's portfolio, so WAM, which has been around for a long time and had decent results. Most of their shares are small caps, if not a lot of them. Their largest market cap seems to be $9 billion. So for portfolios like mine, it might mean a larger portfolio of smaller ADT stocks, but it's something I've got to look at, I think, and something which I need to think about further now that I've understood what's going on with the ASX 300.
Which would mean you'd have to have a larger portfolio, right? So
Correct.
as not to get into ADT exit troubles.
Yeah.
My only point on that is that the light portfolios haven't performed that much better in the last few years, and I can't remember what the breakdown is between small and large cap, but it would be majority small cap because I don't have the ADT restrictions on that. So I don't know that.
Yeah. Look, I had
Small
the same
caps
thought.
I've done that much better out of small caps.
I had a look at the dummy portfolio, and there's only two large caps, Qantas and ANZ, that I could see in a dummy portfolio. The rest are all small caps. I didn't get a chance to compare that to the light portfolios to see what the ratio was in the light portfolios or not.
I did do an analysis on it like last year when I was trying to figure out why the performance for the light portfolios had been sort of mid over the last couple of years. I can't remember the numbers. It's probably in my notes somewhere, but the majority small caps, I think.
Okay.
And because we were looking at this question a year or so ago, is it a large cap, small cap thing? And I did an analysis, and the small caps weren't really doing any better. I mean, there's a couple of good news stories in there, but generally speaking, I don't think they were doing that much better. So
yeah, my experience over time was that it didn't matter because we were always trying to buy the value stock. So if it was a large index or a small index, we were still getting a good bargain. But yeah, that was before this sort of rush of passive investing to the ASX 300s occurred.
Okay.
I'll do some more digging.
What's next? Yeah, you'll think about it.
I'll think about it, yeah. Wanted to continue the... Don't laugh, I think a lot.
I know you do.
Wanted to continue the results roundup with a couple. One being Perseus. So Perseus results were good. Perseus Mining Limited reported strong financial results for the half year ending 2024, December 31st, showcasing a significant increase in revenue and profit compared to the same period in the previous year. The company achieved revenue of $581 million, up 19% from the previous year, and a net profit after tax of $201.1 million, reflecting a 22% increase. Gold production totaled 253,000 odd ounces at an all-in site cost of $1,162 per ounce, so much cheaper than Ramelius. The company's gold sales amounted to 245,518 ounces with an average sale price of $2,350 per ounce, indicating a strong market performance despite rising operational costs due to inflation. That was from the Intelligent Investor. So good result for Perseus. I own shares in Perseus, so I'll declare that. And they are currently ex-dividend. So if anyone's looking at, I think they're well above their 3-point trend line sell, but they won't get the current dividend. The other one to look at today was Metals X, MLX. Again, a long-term stock in and out of the buy list over the years. This is a tin miner from Tasmania, from memory. Revenue was up 42%. Profit was up 602%, from 14.5 million to 102.3 million. So a huge increase in Metals X. And I'm going to read from the non-executive chairman's letter in the annual results, a guy called Peter Gunsberg. In the last 12 months, operation has benefited from a higher than budgeted tin price and a lower than budgeted Australian dollar. These two factors, combined with management's ability to increase both production and recoveries of tin to deliver record annual tin production of 11,000 tonnes, has resulted in an increase in cash flow from operating activities of 121%. With a significantly healthier balance sheet, your board made two consequential investment decisions during the year and announced a possible third. Our first decision was to implement an on-market share buyback, which resulted in 20-odd million Metals X shares, representing approximately 2.3% of the issued capital, being repurchased and cancelled. The second was to acquire 29.91% interest in London-listed First Tin plc, which owns the Taronga Tin project in northern New South Wales and a secondary tin project in Germany. As a consequence, fellow director Mr. Brett Smith and I joined the First Tin board. Our third possible investment decision concerns the Hong Kong-listed Green Tech Technology International Limited. I think it's fair to say, so that's, sorry, I'll stop it there. I wanted to just add his last sentence, which I thought was hilarious. I think it is fair to say that the stars aligned for Metals X during the year, and whilst it is not in management's power to align stars, I am confident they will continue their best efforts to manage those things within their control. Which I thought was very playful. Obviously, he's on a bit of a high after boosting profit 6 times during the year. So that was Metals X.
So what's causing the rise in tin prices? Is it sort of electronics industry boom or what? Do you got any idea?
I don't know. I think most commodities, or a lot of commodities, are doing okay, but I couldn't say what was driving tin.
Okay. Well, 602% profit increase. That's somebody's having a good bonus holiday, a bonus celebration there, I bet.
Especially for any of our listeners who own shares in Metals X, which has been around for a while on the buy list.
Oh, I got to check that. Let me see. By the way, I had to disclose I have PRU2 in my super. I've had it since April 24. It's up 38%. Not going to snort at that. That's okay. MLX. We do own MLX. It's in the light portfolios and the dummy portfolio. Bought all of them in the same week, June of 2023, at 27.5 cents. It's now 66 cents, so up 140%. So we've done very well out of MLX. Thank you, MLX. Good job, MLX. It's down 4% today, though.
Keep up the tin panning. I'm not sure how they mine tin.
Probably with a pan. I'm sure that's how it's still done. Yeah. What else you got?
Just the pulled pork on Shape Australia, but I can wait if you wanted to do questions first. Up to you.
Well, we'll do a question, but before that, I wanted to talk about DSK.
Mm-hmm.
DSK, I had to sell on Monday. It sank like a stone, and I couldn't really figure out why. It went ex-div, 5 cents a share, fully franked, but dropped 20%. And I don't know, it had several good reports recently. I couldn't see any news relating to it. So, I mean, I always sort of dodgy buying a soap business. I was like, really? Soap? I don't know.
Soap and candles. Don't forget the candle side of it.
Candles, yeah. So it's continued to decline too. It's went from $1.32 down to $1.09. So I had to I think 3-point sell that yesterday. It was only in a possible portfolio. It wasn't in a real one, but yeah, I don't know if we have a commodity price for candles or soap, but
Yeah, haven't seen one.
apologies to anyone that bought DSK. It wasn't our buy list, and yeah, 20% down and no news. That always bugs the hell out of me.
Yeah, it's a small cap stock, so it doesn't get much coverage, but I couldn't find any news either. And I suspect that, well, either the news will come out or it's algo trading when ex-dividend started to drop. It just kind of became a bit of a
Just kept going. That's what I
self-fulfilling
figured.
prophecy, which is
I
what
actually
we've done.
said that in my light email yesterday. Yeah, my light email. And well, in fact, when I looked at my alerts yesterday morning, it was slightly below, only a few cents below its 3 PTL. And I'd only added it as a buy the week before. And I was drafting my email to the light subscribers saying, you know what, I'm going to give it some grace here because it's only a few cents below, and I think it's an overreaction to going ex-div, etc., etc. And then it just kept falling during the morning. It just kept falling and kept falling and kept falling, and I went, "Oh, okay, screw it. I got to
Yeah.
bail. This is getting too bad." So I reworded my email. Um, we have a question from Tom that I'll get to in a second, but I did have questions on Josephine and second bylines that I was in Facebook that I said I would ask you about today. This gets back to the original byline question, but there's a few relatively new members that asked about second bylines and charts with regards to, I know Whitehaven was one of them, and the other was NHC. So I just wanted, for new listeners, new club members that are trying to work out the charting stuff, I just wanted to run over this one more time. So if you look at the Bredelator, you will see two bylines. There's the yellow solid byline, which is the original byline. That's the actual byline of the stock. And if you look at NHC, it became a buy back in middle of 2021, and the price has been, well, it went up a lot after that for a few years. It's been declining more recently, but that is still the buy line because it hasn't breached a sell line since then. It's L2 is back in sort of May 2021, and it's got a fairly low buy line, but it has been declining since late 2023. It's been a Josephine, so the green dash line in the Bredelator is what Brett calls the latest byline. We sometimes refer to it as the second byline, and that's the line that we want to see it get above, so we know it's re-established positive sentiment. So the question was, well, should it be on the buy list if it's below that? And that's a good question. I mean, the way that I've currently got the buy list, I put it out, is I do put out stocks that are below their second buy line if they are above their buy line and their sell line, because they're still a buy. And in some cases, we will have stocks that have been a Josephine, but they're fairly close to going above their second buy line, and it can change during the course of a week. So I tend to leave those on there, and then I just check it. If I'm looking to buy something, I'll check where they sit with regards to their second buy line. But there has been some discussion between Tony and myself and Brett over the last year or so about whether or not we need the original buy line or if it's the second buy line that really matters here. And I don't think I think you said you thought there might be examples when we still needed it, but I'm not sure that we ever found one.
Yeah, from memory, it was during the GFC. But basically, the second byline was an attempt as well to try and qualify what a Josephine is. So, looking at that graph you talked about, which I've got NHC open, New Hope Coal's been well above its byline for many years now, but it's been in a sideways to slightly down trend over the last couple of years, and that's when the second byline comes into into its usefulness. So how do you know, even though it's been above its byline for a long time, how do you know when it's breaking out of that sort of short-term decline over a shorter period? Because the bylines worked out 5-year monthly, and then the other ones worked out can be over. It was still using 5-year monthly, but it's a shorter-term trend. And I think it's still useful because, as you
Well,
can
it's
see from
ignoring.
yield, it's below the second byline.
Sorry, yeah, the second byline's ignoring the buy versus sell rule. So, normally if we have a byline, and I've been trying to code this for the last month, so like every day, you would not believe it. Like every day, I'm doing all my other work. I've got a coding discussion going on in the background with an AI where I'm trying to code byline stuff and work through edge case scenarios with it, and it's insanely difficult. But the for new people, we when we're drawing a byline and a sell line, we've got this old rule: the byline follows the sell line, and vice versa. And so what looks on the breadlator as the original byline is the first byline that could be drawn after there'd been a sell event. So then there's a buy event and that if there hasn't been another sell event since that buy event is still valid. It's still technically a buy, even though its price has been declining for the last couple of years because there hasn't been another 3-point trendline sell. And so, I think a few years ago when we started talking about Josephines. The original theory was it was no longer a Josephine if it had a month when the price went back up. But then we realized sometimes these prices decline, for a long period of time. They're a falling knife, and we don't want to buy them until they've genuinely re-established positive sentiment, a positive uptrend. So we needed some sort of a 3-point trend line to go there. So it's the actual current byline. So we take the real highest peak and draw it through the next highest peak that doesn't cut off any other peaks on the right hand side. By the way, as I've been coding this, I've been using the AI to articulate all of the strategic theory behind our 3-point trendline strategies into this long, ever-growing document that has all of the edge cases, but what about this and what about that, and if not this and that, and it's going to be. I'm going to submit it for my PhD thesis when we're finished. I have a PhD in QAV. Anyway, so that's why we have the second byline, and again, in my mind, that's the byline that, if it exists, that's the one that I'm paying attention to, but it's still on the buy list, even though it's not above the current byline, which I think is confusing for new members.
We do that. I remember having a debate about that. We do that because, again, during times like COVID, the graphs can change pretty quickly, and so we put out a buy. If we put out a buy list on Monday and something wasn't on the buy list, and then it did trigger a buy during the week, you wouldn't see that. So we put out everything which qualifies as a buy, even if it's not a buy according to the graph, and then you check the graph when if it's Wednesday or Thursday or Friday when you're buying yourself, you look it up and see if it is.
Yeah, and the breadlator makes that easy to do. You just need to go and check and make sure it's above that green dash. So Daniel asks, taking WHC as an example, this is not currently a Josephine. Well, I think it is currently a Josephine, Daniel. I pulled it up this morning. Let me just pull it up again. It's currently a Josephine. So even though the current price is $5.78 and the previous month's close was $5.63, so it's above the previous month's close, but it's been declining since November 22 when it was at $10. It sort of declined a lot, then it recovered a bit up to January 2024. It got back up to, hold on, my glasses aren't that good. 850, and then it's declined since then down to where it is today, $5.78. So it's a falling knife. It's a Josephine. It's been declining, and we don't want to buy it until that declining trend turns around. Does that make sense, Tony?
It does. And I think what might be confusing the listener was that before we had this coded by Brett, we were using our Josephine test as the current prices above the close-end price for last month. And if you look at WHC's graph, you can see why that's not helpful in this case, because there are plenty of months in the last year or so where that's where the price has gone above the previous month's close, but then it's dropped down again. So it's been a falling knife. And so,
yeah.
So yeah, the fact that this month the price is above the close of last month may be the start of an upturn, but to be sure, I'd rather wait until it gets above the second byline trend.
Because it's had a number of false starts like that.
Yep.
You go back and look over the last 12 months, it's dropped, then it's recovered a bit, then it's dropped again, it's recovered, it's dropped again, it's recovered, it's dropped again. It's not really a good description of a falling knife, but I don't know what to call it. What drops and then rises, then drops again, and then continues to rise and drop? And
a falling butter knife, a serrated edge.
It's bouncing off the kitchen bench, then it's bouncing off your knee, then it's bouncing off of things as it falls down. Yeah. So the whole point of it there is to stop us from. The whole idea behind 3-point trend lines is sentiment.
Mm-hmm.
Like, is the market? You've talked about this a million times over the years, but we can look at all the numbers and we can decide the numbers are great and it's got good management. And sometimes, stocks on our buy list don't have necessarily the best management. Their quality score may be low, but they've got a really low prop CAF, and so they end up with a good QAV score, despite the quality score being not above 75%. It might be 56%. I think one I looked at today met that metric. Actually, it's US stock that I bought, CX. It's a cement company. Its prop CAF was 0.01.
0.01. Okay. So you're buying it for, and what's that? Does that mean, that means you're buying it for cash flow?
Well, pretty much.
Yeah.
It would take you 3 days, 3.6 days, 1% of a year to get your money back. But its quality score was, 56%, but its QAV score was like 48 or something. And I looked at it, I dug in, I was like, oh, this could be a value trap. There's something wrong here. But, the numbers aren't that bad. Like, you look at its profit line, et cetera, it's doing okay. So anyway, the point being that sometimes stocks are on our buy list because the numbers, as we slice and dice them, say it's a good buy. But if the market is dumping it for a long period of time and the price is going down, we don't want to buy in. I mean, there are value investors that will do that and say, screw the numbers. I'm in it for the long haul. And then you say, I'd rather put my money into. Like, it's not like there's only 3 things out there for us to buy, and we have to invest our money. We're not Warren Buffett, where we can't find anything to buy because of the sorts of numbers that we're dealing with. So we can, particularly those of us with lower ADT restrictions, there's always, with rare exceptions in the last 5 or 6 years during massive economic collapses, but there's generally 5 or 10 things on the buy list at any given time that I can buy, and some of those that have positive sentiment. So why would you buy something where the price is going down when you can buy something that seems to be getting supported in the market and the price is going up? If it's just if they both have good numbers, you buy the one where the price is going up, not the one where the price is going down, right? It's just common sense.
And I think it's also fair to say that we look at forward estimates on earnings per share growth, which is only one part of our checklist. But sometimes if a stock has good numbers now and its sentiment's bad, it's because someone's worked out that the numbers aren't going to be as good next half or next year, and they're selling out. So it's a bit of insurance again. But again, if the share price is going down, why don't you just wait until you get it cheaper? Why would you buy today? I mean, you could dollar cost average, I guess.
Yeah.
But yeah. So for the as a bit of insurance against not knowing what's going to happen next year, as opposed to somebody who might have a better hold on that information than we do, and for the very plain and simple fact that if I wait longer, I can get it cheaper. Why would you buy it when the sentiment's bad?
Somebody might have done a 10-year forecast on their gold mine and decided
we must disclose it.
But they haven't. Yeah.
Maybe we should run disclosure workshops for companies. Look, you're meant to do this.
Oh, that's a great idea.
But if you don't press the button on the Excel spreadsheet till you know the answer's good, then you can disclose it. Yeah.
Warren Buffett says if you have bad news, make a phone call. In your case, if you have bad news, put it in the bottom drawer.
No, and you just cut off the bad news before you get it. You just don't do that final calculation. Then you put it in the bottom.
How do you know? Somebody has to know there's bad news somewhere in the. Somebody has to realise there's bad news coming and then make it disappear.
Right.
Put it in the I'm going to think about it tray. And because maybe your numbers are wrong, you go, I better think about my numbers, and then just think about it for a really long time
until the numbers get better.
Anywho, hope that helps Chris and Daniel with understanding why the difference between the yellow line and the green dotted line.
And I think also,
Tom has a
just
question.
Before we leave that, just one other thing to point out is that people can get the most recent version of the Breadolator from the QAV podcast website in the resources section if they are scratching their head and saying, why doesn't my Breadolator have a green line? Because it only came in, I think, 12 months ago. If they've got an old version and haven't updated it, it won't be there.
It was a lot longer than that, but yeah.
Whatever.
At some point.
Yeah.
Yeah. That's how long you've been thinking about whether or not we should only use the 2BL. It was in place for like a year before that, I think. Anyway, moving right along, Tom asks, with the market decline of recent weeks, I thought a discussion on hedging may be of interest to the group, though I strongly suspect TK just sticks with the process and follows the numbers with disciplined stop losses. Wow, Tom, you've been paying attention. I have been considering this recently and asking if investments such as a crypto ETF, oh, that's going to go down well, a Chinese equities ETF, gold ETFs, or put options are worthwhile. Perhaps only 10% of capital allocation, but a hedge against the market pullbacks in Australia and the developed world. Cheers, Tom.
Do you want to answer this one?
What say you, TK?
I wrote LOL beside Tom's question when I saw it today.
There's this meme. I don't know. You must have. There's this meme that's been going around for years. It's from an old Batman, golden era Batman comic from like the 70s, and it's the voice. What do you call it? The voice clouds. The dialogue boxes are blank, and you write in whatever you want. And it's always Robin getting halfway through asking a question and then Batman slapping him in the face with an answer. Yeah. And I imagine I should have one for you. It's like, should we change the bang? No, you don't change the rules. You follow the rules. Tony, you're Batman just slapping us in the face whenever somebody suggests we should do something.
Well, I'm happy to be schooled by Tom on hedging, but my experience is it doesn't work. And all you do is give up performance on the rest of your portfolio. So there's a whole field of questions and subjects raised by Tom. He suggests that perhaps only 10% should be allocated to a hedge. So does that mean if your portfolio, your 90% drops, the 10% is going to make up for it? So why 10 and not 20 or 50? I don't think 10% in a hedge against the 90% of the rest of the portfolio is going to help. My experience is you're getting into the game of prediction here, where you think that that a crypto ETF might help you if the share market's going down. Might, but it might go down too. And certainly during big periods of disruption in the markets like the GFC, like COVID, everything goes down. I know COVID bonds eventually went up, but for the first little while, everything went down. But if you had 10% of your portfolio on bonds, happy days, you've made 100% on 10%, but your portfolio went down 50, so on the other 90. So it doesn't make up for it as such. So it's never been a useful game for me to look at. For a long time, traditional thinking was to have a 60-40 portfolio of stocks and bonds, 60% stocks, 40% bonds, and over time they'd, even out. But, you pick up any sort of newspaper these days and they're saying that era's dead and they've got to look at rebalancing the ratios and all that kind of stuff. I call it diversification. I think you're better off finding something which works and then going all in and sticking with it rather than trying to second guess it. And yeah, I just go back to all the times in the market when everything's gone down, particularly the share market, and everything has gone down. Property, gold, whatever. Sometimes gold stays up like it's doing now. But I have Perseus in my portfolio, not because I think I need to hedge my portfolio, but because Perseus comes up on the buy list and it's got positive sentiment. So you kind of buy that next. So there's kind of a bit of natural hedging going on in the QAV process anyway, but we don't do it to hedge our portfolio. We do it because that's the process. So, Tom, happy to discuss it further, be proven wrong, but I need some evidence because I haven't seen anybody do it well or do it in such a way that it's outperformed a process which gets double market in the share market.
I just made one of these things. I'm gonna share it with you.
Should we hedge? Follow the rules. Yeah. Yeah, exactly.
Yeah.
I mean, there are some people who say that you should go to cash, and I guess Buffett's doing that. He's waiting for the market to crash and he'll buy in. But again, I think that's not him hedging. It's the fact that he can't find anything to buy. So it becomes a natural part of his process rather than a hedge, even though I think it's up.
Yeah, he wants his money to be doing something.
Yeah,
yeah,
correct.
All right, Tom, but, brave of you to ask the question. And thank you.
I think it's a good question. I think that people turn their minds to that kind of thing when the market goes down. It becomes attractive.
Of course they do.
Yeah.
Bitcoin.
GameStop.
I haven't
GameStop. Buy some GameStop. Hedge.
GameStop. Yeah. I haven't looked at the Mag 7 and the Bitcoins and whatever today. Down.
Maybe Trump needs to
Tesla. Look at that.
Go on the front lawn of the White House and pump Bitcoin the same way he did Tesla last week.
Well, it hasn't really helped the Tesla share price. I can tell you that. Yeah. Wasn't that hilarious? Oh my God.
Have you ever seen a president of the USA nakedly shilling a product like that before? It's incredible.
Well, I've seen them nakedly shilling lots of things, but usually it's wars to support the military-industrial complex in general, but not a product like that. But, again, my take on it is it's flood the zone. Have you seen that? Have you seen the Bannon stuff that's been out there recently?
Oh, I've seen it.
Do you remember Steve Bannon?
Stuff. Yeah.
Yeah, so Bannon has come out recently and said that when he was Trump's chief strategist back in the 2015-2016 campaign, the thinking then was, in terms of the media strategy, was flood the zone. So just fill it up full of crazy bonkers stories and then do whatever you want in the background. They'll be running around. And he's basically saying the current Trump team have perfected that. It's just 3 crazy stories before lunch, get the media, licking it up because they love it. because it drives eyeballs to their content, makes their revenues go up. They love it. They pretend they don't. There's lots of gnashing of teeth and wringing of hands and renting of garments, but they love it because it's driving revenue. Everyone's paying attention. Meanwhile, go do whatever you want behind the scenes.
It's Joe Bjelke-Peterson strategy. Feed the chooks.
Feed the chooks, that's right. All right, that's all I got.
We had another question from Tom.
We just did that, didn't we?
No, he's got a second question about the Spartan Resources takeover that we spoke about before. You sent it. It's in the notes you sent me.
Didn't you handle that already?
No. So Tom asked another question.
Okay.
Yeah.
Sorry.
That's all right.
Oh, I thought we handled that when we did the Spartan thing before. I forgot. Sorry. Let me ask it. Tom, again, I've got shares in Spartan Resources that I've held since it was Gascoigne Resources. I didn't realise that Gascoigne had become Spartan. Ignoring Rule 1 plunges along the way, now I'm up about 350%, and it makes up about 30% of my portfolio. Wow. Well, nicely played, Tom.
Well done, Tom.
They have announced a merger with RMS, and I'm wondering how Tony would proceed. Normally with a takeover, I would sell and take the profit, but as RMS is a QAV stock, I'm thinking of holding on and watching the flowers grow. Any thoughts? We've talked about mergers and acquisitions a lot in the past. Let me see if I can recall your line of attack here. Is it analyze the stock that you're going to end up with according to QAV rules, and if you like it, great. If you don't, get out.
Yeah, correct. There's a couple of other twinges or little things on the site for that. And this is not specific financial advice, Tom. You're going to have to work it out for yourself. But that's been my basic rule. It's complicated now because I think Ramelius has bought its copybook with all this disclosure mix-ups.
Red flag. Has a red flag now. Disclosure red flag.
Yeah. So it makes it a bit trickier. But the other thing that Tom needs to consider, and probably just as important, is his tax position, because capital gains tax may get triggered by a takeover. Generally, it doesn't if it's an all-scrip takeover. So there's a thing called rollover relief. So if all the Spartan shares were being acquired by an all-scrip offer from Ramelius, then the tax office would wait until your Ramelius shares were sold before levying CGT. Using the Spartan cost base on the Ramelius shares, this is already getting complicated. But I noticed that Ramelius had a cash component to the offer, so that might trigger capital gains tax for Tom. Likewise, if he decides to sell on market before the takeover, that will definitely trigger capital gains tax. And given that it's up 350% and now a third of his portfolio, I'm guessing capital gains tax will be an issue that Tom needs to consider. So flick your accountant an email and outline the situation and just ask them for their advice on CGT, and then factor that into your decision making. Normally, if it's on the buy list, like Ramelius, and it rolls over and there isn't a CGT event, I would keep it and then just 3-point trade it from there. So that's my sort of general rule. It's a bit murky this time because I'm not sure whether Ramelius is a red flag or not. And Tom will have his own CGT issues, but I'm sure he can work through them.
And what about the fact that Ramelius is obviously going to be a Josephine at the moment?
Yeah, that's part of the complication, isn't it? And you'd expect the acquiring company would be a Josephine. The Spartan's gone up because they're being hunted. Ramelius it's gone down because of the Mount Magnet disclosure, but usually the acquiring company doesn't go up when there's a takeover announced, so it's always probably going to be the case. Yeah.
Yeah. So, I mean, it's well above it. I'm just looking at the breadlater for Ramelius now. Interestingly, it's it's above its byline and above its second byline, even though the share price has collapsed, because it had sort of gone above another, an earlier second byline. The way the breadlater's drawing it is it's crossed a second byline about a year ago.
Mm-hmm.
So
Tell
even
us a
though the
buy.
share price is down, yeah,
And
because
gold's
it's
certainly a
sort
buy.
of yeah,
So you kind
but
of
it's discounting the fact that sorry, yeah, go
go
on.
ahead. Yeah.
Well, it sort of it's a weird second byline if you look at it in the Bredelator. Like it had a small decline middle of last year, recovered from that and passed its second byline, but it's had a couple of declines since then. Um, so I don't know. Would you buy it with the recent price drop, even though it's gone above a previous second byline, or would you be drawing another second byline based on its recent peak and collapse and waiting for a new H2 to form before you get in?
I wouldn't be drawing any more lines. It's definitely a Josephine. Its previous month's close was 263 and its current price is 221. So sentiment's down this month in the short term. So yeah, I'd wait to buy it. It may go lower or it might start to turn up, and that's a good time to buy it. But that's how I read that. That's my strategy on that one.
All right. Okay.
Look, in the absence of knowing the answer to these things, I'd use the 3-point trend lines in the Bredelator um, to
Yeah.
swap Spartan for Ramelius. But please check out the capital gains tax question. I also noticed for the first time that I can remember, there's a clause in the announcement about the takeover that if the scheme of arrangement isn't approved, then Ramelius will go hostile and make a bid for the company anyway. So I hadn't seen that before, but that also, they I don't think the details were there about whether it was going to be a cash bid or a scrip bid, but just make sure if it's a cash bid, you're fully aware of your CGT um, liabilities in that kind of case. And the other thing too is that, as was pointed out, I think in the Fin review today, the premium on Spartan for this takeover offer was much lower than similar sorts of takeovers. So I think the premium for the bid was about 17% from memory, that kind of order of magnitude. Whereas companies in this space in the booming gold market are generally going for 40% plus premium. So this may well trigger another bid from somebody else who can see value in acquiring Spartan as well.
I know the Spartan share price has gone up significantly in this last week too.
Mm.
Gone from $1.36 up to $1.77 just in the last week. So yeah,
What's the offer? You
something's
know what the offer
pushing the
price is?
price up. I don't.
Okay.
No.
So it may already be above the offer price, which means the market thinks there'll be another bid from someone, either from Ramelius or someone else. So Tom, you're in
I'm
the box
looking
seat,
at
mate.
the.
Great position to be in, and lucky you for having Gascoigne turned into Spartan and now being taken over. But just check with your accountant what your CGT options are, and then go from there.
All right. Okay, on to Shah.
Ah, yes, Shape Australia. So I was finding it hard in the using the buy list today to work out a stock that was still going up, given all the general malaise in the market over the last week or so. But Shape Australia has been going up strongly recently. It's new on the buy list this week, so I thought I'd do it as a pulled pork, even though it's not a big stock. Its ADT is probably only going to suit small portfolio investors. Its ADT is 114,000, so I'll call that out at the start. New on the buy list this week, Shape Australia is a construction, fit out and refurbisher of commercial properties. So it's been around for a long time, and it basically does fit outs, but it's just branching out now into builds as well. From their website, they say that they are a nationwide ASX-listed fit-out and construction services business with a team of more than 645 people working across all capital cities and a number of large regional centres. We've delivered more than 7,250 projects valued at $10 billion over the 35 plus years we have been in business. with a focus on innovation, safety, and building trusting relationships. Our clients span the commercial, education, government, retail, and health sectors. While our origins in commercial fit-out have created a strong foundation for the business, our $3.2 billion pipeline for FY25 spans fit-out and refurbishment to facade restoration, design and construction, new builds, and modular projects. So that's basically what they do, and a bit of their history. They have an association with a company which looks like some kind of joint venture called DLG Shape, and I wasn't able to find the exact nature of the relationship without digging too much deeper than what I did. But DLG Shape is some kind of joint venture with an Aboriginal focus company, which is in partnership with the David Lydiard Group. So David Lydiard is an Aboriginal business person who's done a lot of work in getting Aboriginals to own, run, and be employed in businesses. And Shape have worked with them to create a part of their business to foster those career paths and ownership and employment opportunities for our Indigenous nation. DLG Shape had nearly $100 million in revenue for the year, so it's been somewhat of a success for them. Latest results are good. Revenue's up 15.4%. Profit after tax is up 25.6%. And they went ex-dividend a little while ago, but the dividend has now been paid on the 10th of March, which was 10 cents. So we can use the bread later without making an adjustment for them. They called out in their results that they've undertaken 2 expansion strategies in the last 12 months. They have actually 3. They've moved away from the commercial sector or the office sector, and they have won contracts in hotels, education, health, retail, and defence. And they've also expanded geographically and won tenders on the Gold Coast, Newcastle, and Tasmania. And so they're now branching out and putting some offices in those locations as well. They also launched 2 new divisions last year, which are growing okay. One's called the Aftercare and Facilities Management Division, which looks at maintenance of work that they've done in the past. And they've also now have a design and build business, which is, as it says, designing new construction. They did also call out that part of their business is starting to slow, which is called the facade remediation work, which is to do with replacing the cladding on buildings that wasn't fire resistant enough. So that's sort of coming to its end naturally. But the revenue was still at 15%, even though that part of the business was slowing down. One other thing to notice is that Shape Australia, even though it's a small cap company, has is just about to be added to the All Ordinaries Index on the 24th of March. So that announcement came out a little while ago, and I think that's part of the reason for the share price increase as fund managers try and get the bump from inclusion in the index. And I suspect on the 24th of March that the bump will continue as fund managers who back that index include it in their portfolios. So I think in the short term, the share price will be underpinned at least. Going to the numbers, the price I used for this analysis was $2.96. It's 17% lower than consensus share price, so that's good. But it's above IV1 and IV2. IV1's $1.08, IV2's $2.22, so we can't buy it from that perspective. The yield is strong in this company, 6.35%, and just above our hurdle of 6.12%. NEPS is only 40 cents per share, so we can't buy this one for book value. Stock Doctor Financial Health and Trend is satisfactory and recovering, and we score it a 2 for recovering. Stockopedia give Shape a quality ranking of 94, which is good, and an F score of 7 out of 9, which is very good. Stockopedia have an overall rating for Shape of 99 in their ranking, which is out of 100, so that's excellent. We don't score for ROE, but I did notice that ROE was 58% for this company, so that's pretty good, pretty profitable. PE is 14 times, which is neither highest or lowest in the last 3 years, so we don't score it for that. But prop cap is only 5.5 times, so that's one of the reasons why it's on our buy list for from a value perspective. Forecast earnings per share growth is only 6%, so we can't score it for that. Directors hold 5%, so we're not going to score it for owner-founder. However, I did a bit of digging, and the original founders still hold approximately 30 to 40% of the shares. So there's still a significant amount of owner-founder ownership of the company, even though they're not sitting on the board. One of the founders, Stephen McDonald, passed away recently, so that may affect that number. But the other founders remaining who hold shares are Gerard McMahon, Daryl Drayton, and Mike Van Leeuwen. And as I said, they still own between 30 and 40%. Lastly, SHA is growing its equity consistently, which is a nice thing to see. So overall, quality for this company is a score of 10 out of 15 or 67%, and the QAV score is 0.12. So towards the bottom of the buy list, but new on the buy list this week, and the share price has been going up, so something to have a look at. Strengths, they're at pains on their website to talk about their people culture, and sometimes that can be just lip service, but it does seem to be part of their culture, so it'll be a strength. And it's also potentially shaping their involvement with DLG Shape, their Aboriginal business. I think it's good that they're growing the business away from office fit-outs, but and that would have been a good thing to do when work from home was in its starting its trend or happening in droves. But that seems to be reversing a bit now, with more and more companies mandating returns to the office. So that may drive that business again for office fit-outs to accommodate people returning. So that might reverse. I think the risk for a company like this, like any builder, it's cost blowouts, and they've been managing their costs well according to their results. So their margin remains strong, even though obviously wages costs have been going up and product costs have been going up. But cost blowouts are always a risk for this kind of company, as is tendering risk. So, getting caught with the wrong kind of contract when costs go up. So mitigating those two things, though, are the fact it's been around for 35 years, and the management's very experienced through a number of cycles like this, so they should be able to, they're showing that they can manage those risks. So, that's SHA, interesting company I hadn't heard of before.
Thank you, Tony. They have been on the buy list before this week at some stage, because I've had them in the light portfolio for a while.
Okay.
But not that long. So I think they turned up a few weeks ago or something, yeah. But dropped out and then came back in because, let me see, when did I add them? 5th of March. Oh, so only 2 weeks ago, right? So they're up 1%, killing it since then. Good job, SHA. Keep it up. All right. Well, that is that for this week. After Hours. You had a win, Tony.
I did. Changes had a win at Geelong on Saturday, which was great. I think she might have a bright future as a 2,000-metre horse. We had Bathwick run. He ran third, and then we had Lake Forest run sixth, which was a bit disappointing. But it was nice to see one of the horses win last week. And also Perfect will have a run this Saturday at Moonee Valley. At least that's what she's nominated for. So she's back into work now, which is good. Good to see. Back to the races.
Now that you're down there, were you at Geelong? Are you going to Moonee Valley?
I didn't go to Geelong because, except for taking the ferry across, it would have been a long trip. But I may go back to Moonee Valley on Saturday, yeah. See my horse run. Always good fun.
Top hat and tails. Get the mono. So what do you call it?
You haven't been to Moonee Valley for a while. No, probably just business casual, I think. I might wear a suit.
Oh, okay. What do you call one glass? A
monocle.
Something. Monocle. Good magazine. I should have remembered that. I used to read Monocle magazine. You ever read that?
Oh, ages ago, a little bit, yeah.
Used to be in airports, fancy places like that. Very good. Well, congratulations.
Yeah,
That's
thank
nice. You. Nice to have a win.
Yeah, I was very happy.
You seen anything good? Read anything good? Heard anything good?
I'm still going through source code, which I'm really enjoying. But, I mean, other people wouldn't because they weren't into computers like I was when I was 14 or 15, like Bill Gates was when he was 14 or 15. So it brings back a lot of memories for me. Yeah, so that's good. No, haven't watched much. I mean, the new season of Full Swing's out, so I've been watching that. Players Championship was on the TV, so I watched that on the weekend because it's probably the first
It's a
big
golf
golf
show,
tournament
full
for the
swing,
year. Yeah, it's a Netflix golf show. And I went to the Formula
like
One
a
on last Thursday, which was
fictional.
good fun.
Oh, did you see Hunter there?
No, no, did not.
Hunter flew. I just picked him up from the airport this morning. He was in Austin, Texas for a Ben Affleck event, and then he flew to LA, did some events in LA. Then he flew to Melbourne for the F1. Flew all the way from LA, just went straight through to Melbourne. He was being hosted by Qatar Airlines, one of Taylor's new clients is Qatar Airways, and they hosted some of Taylor's talent there. So yes, Hunter was in a box
No,
for
lovely.
them.
Yeah.
Where were you?
Oh, I was walking the grounds with my brother-in-law who had a spare ticket on the
Oh,
Thursday too.
right.
Yeah, so Taylor would have been there on Sunday probably. But it was good to get out.
Hunter.
Hunter, sorry. Good to get out. Good fun.
Taylor's in LA.
Okay.
Yeah, nice. Loud. I've only been to the Formula One once. Very, very loud.
Very loud. And a very high-pitched mosquito sort of noise. So it's very distinctive.
Mm.
Yeah, I mean, Shell used to be a sponsor, so I used to go quite a bit into the Ferrari pits and all that kind of stuff. So it brought back memories. So I haven't been for 10 years or so, or more. But good fun.
Mm. Very good. Did you have any money riding on anything?
No,
You put
I
a little
didn't.
bet? No.
I didn't. No.
Well, I'm here alone. Taylor's in
Mm.
LA. Hunter just got back, but he's been away. Chrissy and Fox are on Bribey Island for a school camp for a few days. So I've been batching it for the last day and a bit, but they're back tomorrow, so it's not going to last. What else? I've been obsessed with Shostakovich still. It's taken over my brain. All I do is listen to Shostakovich 24/7. It's kind of crazy. It's a virus. I've started to suspect that maybe Shostakovich was a KGB agent, and his music is a virus to infect the minds of capitalists. Although it didn't work with you, and you're the biggest capitalist, but it's
Uh,
maybe it identifies proto-communist socialists that it can infect, and unfortunately, Shostakovich, his reputation is that he hated Stalin, so I'm not sure how that works. But it's infected my brain.
I'll have to go back and try it again. I couldn't get into it when I tried the first time.
Well, I think you got to find the right starting point, I guess. String quartet number 8,
Okay.
one of the symphonies, 5th, 10th. Listened to the 10th on my bike ride. I did a big bike ride last night and listened to the 10th symphony. It's got some great stuff in it. It's the one that he did when Stalin died. It was sort of his maybe we can all learn to breathe again now symphony. What else? There's a good series on Netflix called Pantheon that I've been watching. It's an animated series, basically about a girl and her mother, teenage girl and her mother, who start to suspect that her dead father's mind has been uploaded into an AI. Somebody starts reaching out to her on chat rooms and message boards, and she comes to believe it's her father, who passed away a few years previously and was involved with some sort of shady digital mind uploading type organization, and think he's conscious in the machine. And it's pretty well done. I've been enjoying it.
Oh, good.
That and the second season of Severance that Chrissy and I have been watching.
Yeah, I haven't. I've got to get
Now and
started on
again
that.
when we get a chance to watch stuff.
I'd like to see that.
You haven't seen any of it, or just
I
haven't seen the second season?
haven't seen the second season. I watched the first season, and I'm waiting for Jen to catch up so we can watch the second season together.
Yeah, right. Problem is, it was such a long gap between us watching the first season and the second season that we're like, who's that? What did they do? What happened last time? I can't remember. I have to ask the boys because I think Taylor watched them back to back. So I'm like,
Ah, okay.
who's she again? He has to tell me. Um, Taylor and Amy, his girlfriend, have got tickets to the premiere. I guess there's an event. The final episode of Severance comes out this week. There's an event happening in Hollywood with all the cast and Ben Stiller, and Taylor and Amy have got tickets to that she got from her agent. They're like doing, sort of after party stuff with all of them, I think. So
Oh, lovely.
it'll be fun for them.
Yeah.
Tell you the other thing I've been listening to, which you might be into, is early Blondie live recordings. There's a bunch on Spotify I just discovered recently, like late 70s, 78, 79 live gigs from Blondie at various places. When they were like a punk band before they went
Atomic.
sort of full disco.
Giorgio Moroder. Yeah.
Yeah.
Yep.
Yeah. Well, um, the we've talked about this before, but the hanging on the telephone and Heart of Glass were co-written, produced by Brisbane boy Mike Chapman.
Mm.
And on Spotify, they have demo recordings that he did where he sang the bits and did the production. And if you go on Spotify, you can find Blondie's original demo of Heart of Glass, which was called something else. It's one of the other lyrics from it. And it's a reggae song.
Uh-huh.
And it was Mike Chapman, I think, that decided to put a faster beat behind it, and then Chris Stein came up with the digital thing behind it, and you can sort of, there's like 3 or 4 versions of it on Spotify. You can see it go from a sort of a funky Island Records reggae beat through to what it ended up as, and it's kind of fascinating. But yeah, but they got a song "Kung Fu Girls" that has become Chrissy's theme song now, which is just a really kick-ass 3-chord Stooges-y type punk track. They could really throw down in their early days.
Oh, yeah. I really liked them. And then Des McCauley gave me crap about them because when they went with Giorgio Moroder. But Beat to the Beat, I think was at Parallel Lines. They were great albums in the late 70s.
Yeah.
What was the movie with Debbie Harry in it? I'm just trying to remember. There was an indie movie where she did a couple of tracks.
Yeah, I vaguely recall that. Just looking it up.
Yeah, I'm trying to as well.
Videodrome, 1983.
Don't think so. Union City, maybe?
Hairspray. She did a version of Hairspray.
I remember that there's Union City, but I don't think that's it. It's not the one I'm thinking of where she was out in the desert playing. I can't remember who it was. Way back early days.
Well, there was a film called Union City, Roadie, Videodrome, Rock and Rule.
Oh, it might have been Roadie.
New York Stories, Girl at Blind Alley. Don't know. Anyway.
Yep, anyway.
It's good to get into that. I haven't heard early Blondie for a long time.
Yeah, very good.
And I'm still reading Bukowski, among other things. But via Bukowski, I came across this guy I was going to ask you about that he was a big fan of, but was sort of little-known writer. A guy by the name of John Fante. His most famous book is called Ask the Dust. Well, I was reading one of the notes of Dirty Old Man parts, and Bukowski was talking about the books that people should be reading. And Fante, he says, the greatest writer of all time. And when I looked him up, turns out that he was the guy that inspired Bukowski's style of writing. And he didn't have a lot of success, but I thought you might have known about him.
No.
So I got my hands on this book, Ask the Dust, or whatever it's called. Fante, Fante, yeah, Ask the Dust. So when I finish the Bukowski, I'm gonna read that because it's interesting. Digging back into that sort of mid 20th century American skanky literature, which is always fun.
Yeah.
Bukowski's so great though. It's just like almost every paragraph of his, I just want to copy into my book of notes. Just so much great stuff. Anywho, all right. I know you got to go. I got to go. Have a great week. Thank you, TK. Have a good week, everyone, and we'll be back next time with more. See whether or not Trump crashes the market the next week.
Yep.
Yeah. You think?
I'll
think.
All right. We'll have Chairman Mad to quiz about it next week too. Yeah.
Oh, we will. Yeah. I'm sure he'll be thinking about that between now and then.
Yep. Have a good week.